Welcome to the Private Equity Experience Podcast, your backstage pass to the strategies, stories, and secrets that drive value in the PE universe. No filters, no fluff, just straight talk and expert insights to help you navigate the private equity world with confidence. And now your hosts, Ed Barton, Rory Liebhardt, and Emily Sander.
Hello, private equity boys. How we doing?
We're good. It's been a minute. It's been a long time.
Been a while.
It's tax season's fault.
Yeah. Seems like the whole world's changed in the last couple months in a way.
Yes. So we took a little hiatus because of tax season. Ed gets buried in tax season.
Yeah.
He just goes away, and then he resurfaces. And he has come up for air now. So
Like
it's nice to see you, Ed.
Yep.
I'm glad to get a proof of life on this podcast with you.
Yeah.
And Rory, you've had some changes as well.
Yeah. I went from doing a lot of consulting work to going full blown, head first into working for a startup, or I should say early stage business. So not totally a startup, but much earlier business than I've worked for in the past. And so, as those things go, kind of all consuming, but it's been a ride, and it will continue to be a ride. So
You're CFOing?
I am. Yep. I started with this company, to a financial, it's been over a year that I started doing some consulting work for them. But then as soon as I got under the hood and I saw what was there, I was like, boy, this is a gold mine. It's a fintech platform and consumer lending platform. And I was like, I want to ride this thing to the top because there's some special and unique stuff going on there. So been a good ride, but never easy running a startup, that's for sure.
You and I had some conversations about that decision.
Yeah.
It was like,
Which way
do I go?
We had some serious heart-to-hearts about that.
Yeah, we did.
They were very instrumental and kind of helped me get off that fence of hedging, which I like to do a lot. Try to not optionality. Yeah.
Oh my gosh.
So you can only go one way with a startup, and that's all in kind of. So so it's been good. It's been a ride though.
Very cool. Okay, Rory, you took the plunge.
Yeah.
Got load of risk. Is this like a true startup?
Well, it's one of those things, without going too deep into the weeds. It's a business that's been around about 10 years. Started as a buy now, pay later business in Canada, and then pivoted to being a full-fledged personal loan provider in the U.S. And like a lot of businesses, they start with an amazing vision and things, but do go like a circuitous path to figuring out what's really trying to be in the market. So I came into the business with a CEO that was brought in by the founder of the board, really awesome CEO, and now we're operating the business, and it's all of the tech and infrastructure really already been built. So it's really just making the product and market come to life, and that's where we spend our time. So, and then also a lot of capital raising too, of course.
Who's the sponsor there?
It's a widely held investor base in Canada. A lot of very wealthy, highly successful Canadian business people. A lot of them from the Calgary oil and gas industry. So it's one of those, hundreds of investors, individual investor type of deals. But once we kind of get to the next funding round, it'll be led by more of an institutional venture capital type group. So, yeah.
And Ed, will you regale us with your tales of tax returns, or?
I had an acquisition roll-up strategy over the last.
I was about to say I've been working really the acquisition. The tax season put a lot of the roll-up piece / integration piece on hold. The last thing you do as a financial professional is try and make major changes in Q4, Q1. And so we closed in Q4. So we essentially were running 4 different accounting platforms, bookkeeping platforms. We're running 2 different payroll platforms. We're running 2 different tax platforms. So we're just starting now to do some of those integrations, and continuing to run into interesting issues. That let's just say that the systems that were in place were very customized. So 175 clients, 175 processes.
Yeah.
So we're working to standardize those, because what's happened, of course, is you have an acquisition. This is typical in professional services, where you do an acquisition. Someone, you have folks who are like, yeah, I it's time for me to go. So folks decide to leave at that point, and then you end up in a situation where those 40 clients had 40 different custom processes that you can't transition in 2 weeks.
Yeah.
So, it's been a real challenge from that perspective. Having said that, it was a good tax season, busy tax season. We were turning down work and are still in the process of being very selective as to who we take. It's been shocking.
Yeah.
At really how much demand there is for basic financial services.
And just to give people a sense, not a deep sense, but just a high level sense of tax season, there's rolling waves of this thing. There's business tax and individual tax and extensions.
So the first wave is December 31 to December 31 to January 31, where you got to file all your information returns. 1099s, W-2s, W-2s, 1095s, all those are got to get out. And then you roll into into 98s, and then you roll into the next phase, which is all your corporate partnership returns are due by the 15th of March. Then your individual returns are due by the 15th of April. But if anybody extended their partnership or S Corp returns, anything that impacts those individuals, then you have individual extensions. So we still have, we have probably 1,200 clients in the firm. We still have probably 500 returns left to file because of extensions. And
I'm one of those extenders myself. Just putting off the inevitable bill that's coming up with minimal interest.
Okay. Those were a lot of tax return numbers. For the 4 listeners who are still with us, we're going to talk about the economy, what's happening in the market, tariffs, what the impact is on PE, because they're getting smooshed. That's a technical term. They're getting smooshed.
Yeah.
So maybe let's outline what is going on in the economy right now. Some people say we might be dipping into a recession. We got the whole tariff thing going on. What is the fancy words for what's happening in the economy?
Economic malpractice.
Yeah. That's one way to put it. The other one I think that comes to mind, I hear bandied about multiple times daily, is uncertainty. There's been a lot of action, which has brought uncertainty, which in so many ways brings on inaction and trepidation. And so a lot of things unfolding from that sort of viewpoint, fear sort of for some, hardy folks, it needs opportunity, I guess. But in a lot of ways, it's just a lot of, not knowing which way to go with your business, with your investment strategy. Your options become potentially more limited in how you execute, your private equity strategy, or there's so many things you can dig into on that.
How does connect the dots between tariff, what's happening with tariffs and why that affects a PE firm?
I mean, I really think it goes back to what Rory just said. It creates this uncertainty of most businesses. It almost doesn't matter what the business is, even service businesses like the one I run. They're international in scope. They have their supply chains are run internationally. They may have international clients. They would be sourcing labor internationally. And so just the tariffs alone, as Rory said, it creates this uncertainty where you're not sure what the future economic return of that asset is going to be. It could be really high. It could be really low. It could, because of the nature of those kind of uncertain events on a tax side. Tariffs are taxes. And so as a result, folks are like, forget it. I'm just not going to, I'm going to hold until I can see, until some of that uncertainty comes out, or if they go to sell. And I know we've talked about this, and I know you get really excited, Emily, when I talk about it, but it changes the risk premium required. And so as a result,
thank God you brought up risk premium. I was waiting.
They're going to pay less, because the risk premium's higher.
Yeah.
So you mentioned a few things there. So the whole time, so we talked about, 5 to 7 years, typical on average whole time. If you were in a a fund where, hey, like, or in a company where we're on like the 7th year, so we were looking to sell. Does this economic environment now push that out?
But very potentially. There's a few things at play there. So in order to sell, you need to have buyers, right? We talked on this podcast, it's in our book, much of the PE investment strategy involves leverage and cost of funds related to that. So taking on debt to finance an acquisition. Well, even as of the, date of this very recording, and it was very recently put out there that the Fed's gonna, delay making rate cuts, right? So think about that in layperson terms. It just means the cost of money is going to stay relatively high for a time, right? So the ability to take on more debt to finance an acquisition means potentially less buyers if you don't have access to that, which if less buyers, then as a seller, you may not be in a position to have as much of a competitive process for selling the company or asset you're holding. You may have other obligations on your own fund related to debt, maybe on the company. There's a whole litany of reasons where what we're talking about right this very moment means that there's just not as much transaction volume happening in the market for so many reasons. And if you don't have that, then it just makes your outcomes more uncertain. And there's a lot of ways to skin that cat per se, but that's what it means. It's just deal activity is just down overall. And right now there's firms collectively that are holding $3 trillion of assets, with half of that they've held for over 5 years in the space. So think about that for a minute. In a lot of ways that one might relate this to their own personal life. And we talk in our book about real estate and kind of the thing people relate to is like, think about your home. So many people sit on trillions of dollars of what's called trapped equity, meaning your home has appreciated since you bought it. Great, that's awesome. You have an asset set that's appreciated, but in order to realize that value, you need to unlock that equity or take that equity out, cash out, what have you. But oftentimes, if you sell your home, you get a big profit. Well, you have to go buy another home, but then you'd have to take on an interest rate that's maybe 2 times as much as what you've been paying on your current mortgage. So you have to think through. And
potentially pay capital gains tax on the sale.
Double, triple, quadruple whammy. So you just need to think about the outcomes of, yes, if you move to sell an asset, what does that mean on the next step? You go buy more assets at a higher price, less liquid.
Hold on. Okay.
So much going on.
I'm trying to hang in with you.
Right.
Okay, so
break it down.
Well, trapped equity.
Yeah.
That's a cool term.
Yeah,
trapped equity. So
it's super cool unless you're trying to untrap it and it's trapped in your own life. Not cool.
Let it free. Let the equity free.
Yeah.
So if I have a house and it's like appreciated, so I'm sitting on equity and I want to sell it, but first of all, there's no buyers. Is the first problem.
Because
so
buyers need to get
right now,
attractive interest rates to be able to afford your home that you're selling.
Right. Yeah. So like the analogy is, I'm a PE firm. I have this company that I bought. It's grown and it's appreciated in value. I want to sell it, but there's no buyers. That's problem 1.
Yeah. To say no buyers is probably a little overstated, but your point is spot on. Yeah.
The buyers are skittish and a little more reluctant, and
they're not willing to buy at a price you're willing to sell for.
Because what did you say, Roy? The cost of money is uncertain?
Yeah, or high. Straight up. It's just high right now. Yeah. So for them to be able to buy your company, they need to probably put up more cash out of their own back pocket, or I should say out of their LP's own back pocket. And to take on the debt, they would have to pay a higher price for that money. Let's just use real numbers right now. Back in the heyday, let's call a couple years back, you might have had an interest rate of like 4.5%, where the cost of money was like, the risk-free rate was like 0. So you add a 4% spread on that, you're looking at 4 or 5% interest rate. Well, guess what? Now it's closer to 8, 9 for the highest grade debt, 9%. So that's double your cost. So if you just think about if you bought a home and your mortgage payment was $1,000 per month for, 360 months, you're looking at maybe like almost doubling your payment for that same house just to be able to afford it. So you have to think again as like, well, I could sell my home, bank a lot of profit, and to Ed's point, have to hire Ed's firm to help you calculate the capital gains tax you're going to have to pay. But then you also have to go buy a new home place to live. Just like private equity is the same way. They're in the business of doing deals.
Okay.
That's the tie-in. They're in the business of continuing to buy deals and sell deals.
Okay. So first problem is I have trapped equity, buyer market lower than it was. Second problem, if I sell this sucker, I have to pay capital gains, which is now more than normal or
It's the same, but you when you have a transaction, if there's a gain on that transaction, which you would certainly hope there would be, you have a tax that's going to be due at the LP level or at the corporate level.
Yeah.
Essentially, you got a profit that you got to pay tax on. And you need to figure out where, probably more importantly to Rory's point, is you now got to figure out where to put that money back to work.
Right.
Because you can't just have it sit in a savings account.
Yeah.
Well, that's the third one. But like the second one, is that affected by the market as well? Does the capital gains rate change, or is that unaffected?
It's relatively unaffected because it's statutorily set, but
that's right.
Okay.
Yeah.
So like the big second problem is I've sold it and now I have to redeploy that capital, and now I'm in this like higher interest rate environment.
Yeah.
I'm like, I might as well just hold.
And here's where that tax piece comes in. If you don't have a good alternative to reinvest that money and make back the taxes you just paid plus a return, you're better off just holding the asset.
Yes. Okay. Got it.
Here's the problem with that. Introducing a segue, new topic, same subject. Well, that term LP, limited partner, they want to get their money back at some point. So what does that mean? There's pressure to sell, right? You in order to generate liquidity, which means basically accessing cash, you have to sell an asset, but you need to be able to sell that asset to pay back your investors, call it. Now, we can get into some esoterica around that because you could then sell secondaries in your position, yada, yada, yada. But point being is it's a challenge right now because LPs, as we just talked about, in general have been in these deals longer. They want to see their own liquidity because at the end of the day, an LP is a person or a firm that is invested in your fund, and they have their own obligations in their life too. At some point, they put $1 in, they want to get $4 back, so they can do what they want to do in their lives, right? So that's the other part. And if you're not able to, this is the other point, is if you're not able to return capital to your LPs, how can you raise more capital for your current or new fund? So it's this massive chain reaction, and it's not just tied to private equity. Private credit's the same way. Other investment strategies. It's just a money flow thing, and that's what really comes down to tariffs and stuff. At the end of the day, is money flows. There's been some activity on the part of the current administration to try to govern and impact money flows in a big way, which has created uncertainty, which has had this trickle-down effect all the way to how much I'm freaking paying for a dozen eggs. And it's too much on that front, I can assure you that. So
my grocery store had a quota on the number of egg cartons you could buy.
Yeah, rationing.
Too, and I was like, hey, if I want a freaking 10 egg omelet, I should be able to have one.
My protein, exactly. Yeah.
The most bioavailable protein out there. Come on.
Exactly.
So LPs, so it's like I want my return, but also, hey, if you want me to reinvest in a future fund, you better pay up. And if new LPs are sniffing around going like, hey, like, should I be investing here? Ooh, like they have been waiting for their payback for a while now. I don't know about this one. Then it's hard to fundraise, yes?
Yeah.
Like a double whammy.
And time is not on your side when you're calculating internal rates of return as well. So, again, getting into the way in which PE groups get paid, it's based on the carried interest, which is effectively a profit share based on the returns that you're distributing to your LPs. So the more and quicker you can get money back to your LPs, the higher their investment return is going to be, which then speaks to how effective your fund is, which speaks to how well you can market your fund to the existing investors and new investors. So, now is a hard time, and I can tell you from personal experience, is not the easiest time to be raising equity, period. Yeah.
How long can PE stay in this stage of things before it starts to get really bad?
Oh, it's a resilient asset class. PE, if they can get through the Great Recession of 2008 through 2010, we'll weather this storm. It makes for just interesting dynamics, like it's not totally uncorrelated to the overall market. I mean, our stock market portfolio, our public equities portfolio got smashed in early April. I'm glad I was sitting in Hawaii and not, at that time and not just, curled up in a fetal position in rainy Seattle at the time when that, Liberation Day happened. But that being said, I'll joking aside, it's just, these things ebb and flow. This is a different type of, catalyst for correction, but it's a correction nonetheless. And like private equity, private credit, they're foundational to the economy, world, and kind of domestic. And, it'll still be there,
So if they've weathered these types of storms before, is it predictable in the sense like, okay, when this happens, PE firms do this? I'm assuming there's like for the portcos in flight, they might tinker with that or change some things there, and they might say, okay, for this next round, we're going to do a few things differently. Do they do any like adjustments, or do they just kind of let it ride?
Yeah, jump in. I got some.
I was going to say, my experience has generally been if there's an opportunity for them to exit that investment and to do it in a way where they can take some chips off the table, they're going to do it. They're not going to go, well, we're just going to kind of let it ride because at the macro level, we're letting things ride. They're still going to be looking at deals at the deal level. They're still going to be going, well, there's deals to be had. We're going to look for them. They're just harder to find.
Yeah.
And so the deal flow slows.
Yeah.
But it's not like at least my experience has been, and Rory and I were heavy in the private equity world when during the 2008 financial crisis hit.
Deep in.
I mean, our
was our entire business. Consumer.
I was about to say our parent co or our fund was essentially going out and trying to buy everything they could find. And they still were executing sales as well. Sales of real estate, sale leaseback agreements. I mean, it was deal by deal. But the key was they felt like if we exited investment X, we could put the money to work in investment Y and still get the return that we're looking for. It's just that some of those investment Ys are harder to find.
Yes.
So if a recession hits, are you saying like the contrarian point of view is just like blood in the water, like buy everything you can?
I think there's a whole swath of firms that is their entire strategy. Yeah.
Yeah.
What was I going to say along those lines is that one person's trash is another person's treasure in some ways. And I think there's so much cash, despite the fact that, it's uncertain times, accessing, debt capital is expensive. There's still a ton of cash out there. So if you're sitting on cash and you're looking to buy deals priced with uncertainty in there, i.e., higher risk premium, lower price, then you're in a good position because you can get deals done. And then when the interest rates become more attractive, back leverage your deal and do really, really well for the same relative risk. So the point I'm trying to make, I suppose, is that no matter what the environment is, there's always innovation and people trying to figure things out. These are really, really smart people that run these firms. So they figure out ways to do a lot of financial engineering to make things work. And I touched on it a little bit, but one of the things that's happened around creating liquidity is private equity groups selling their positions, even though they're still owning the business. Perhaps you're not selling a business; they're selling their their investment in the business to other parties. So they're syndicating out that duration risk to get liquidity to pay back their investors to then raise more capital and do whatever they will do. So my point is, where there's a will, there's a way. And with money, people always find a way to figure.
And did you say that was individuals doing that?
Oh, I know. Well, shoot, yeah, there is individuals. I've seen a lot of private offerings where I can go log into a website and buy private equity secondaries. Yeah.
Wow.
Basically buying their, think about it the same way as you think about owning a public share of stock, is private equity groups parsing out their positions in these companies and selling it to accredited investors privately.
Because they would prefer the liquid cash now.
Yeah, well, they need to.
Yep.
Yeah, for maybe some other operating agreement reason, or just practical, I need to get money back to my investors to get more capacity.
So you're saying that can happen at like the individual, managing director level, or like a...
Yeah, just like let's use, I don't know, KKR. They're probably not necessarily doing this, but like maybe they have $500 million of investment in a series of companies, and they want to sell half of that share, and they can parse that up and sell it privately as opposed to listing on an exchange or something like that. So they can sell positions and then they can get liquid.
Are there PE companies that are built and meant for down markets? So I'm thinking like there's ETFs, and then there's like inverse ETFs, which like when the market goes down, they do well, and they're just structured in a way to perform when there's a down market.
There's contrarian funds.
Yeah. Are they like licking their chops right now?
There's literally probably a fund out there called Contrarian Capital Management, I guarantee. I'm almost certain of that. I'm sure. I could Google it right now, but I'm not. I just know.
So like there might be those firms out there where they're like, this is our prime time. And or Rory, you mentioned like if you have a different risk premium or a different risk profile, some of those might come into play here too, where they might not get as big of the bite of the apple in a bullish economy because everyone wants like the top rated, blue star or whatever you want to call it, PE firms. But now, okay, we're willing to take on a little bit more risk because we need to deploy this capital somehow. Is that a thing?
It is. I mean, if you think about, Rory and I had worked with Lone Star funds. And Lone Star funds, certainly at the time that we were there, their entire investment thesis was, can we find assets distressed? Can we buy contrarian? Can we look at, asset liquidation values? How do we look at these investments differently than as a can we grow this and, get a multiple on an operating business? They were very contrarian. That was their key.
Okay. So if I'm like a founder thinking about this and I was like, I want to partner with PE, but I'm being smart and I'm listening to this podcast. Yeah. I know the market conditions. And so I might keep that in mind when I'm vetting the PE firms. And then the other way around, are PE firms looking for certain types of companies? Are they looking for different types of companies now? Or does that remain the same?
No, I think I think it's less type.
Yeah.
Because everybody knows that the economy's cyclical. So it's going to be, how does this cycle and, those kind of things. It's going to be more, how do I get to a return that I'm comfortable with? Mm-hmm. How do I get to, is this an undervalued opportunity that someone else, like Rory said, sometimes they have to raise money for capital calls or other things. There's, issues around fund level debt where they're going to have to get liquid. So sometimes funds are in a position where they're forced to sell.
Yeah.
And there's that's going to be one of those where it may be a company that's completely, kind of counter to the current economic trend, or maybe right in line with the current economic trend, but they're going to look at it deal by deal and go, hey, is this an undervalued asset? Do we think, over the next 3 to 5 years, typical hold period, we're going to be able to get a good return on it? And if we can, we're going to take advantage of the fact that this owner, this founder, this other private equity firm is being forced to get liquid, and we're gonna jump in and kind of profit from that opportunity.
So, I mean, we've talked about this before where a PE firm could sell to another PE firm. Could this be a catalyst for, okay, we're just going to move our money over to this other PE firm because they're willing to take this on and we're not?
Yeah, and who knows what kind of deal making there could be under the, behind the scenes. There could be a reciprocal agreement to buy an asset from that same PE firm under different terms, but it's in the interest of both parties to do a deal on either side. So it's a small world. People figure out ways to meet their objectives, and a lot of times similar types of firms have the same objectives, and they're in the same sort of macroeconomic situation.
All right. So prediction time. As we look forward here, tariffs. Do you two think that the situation with tariffs is going to get better, stay the same, or get worse?
It'll get better because it can't get much worse.
Yeah, I was going to say something very similar.
This has been, and I've said this to numerous folks. I think the current approach to tariffs is the worst piece of economic malpractice since the Hoover administration, when they also were like, okay, we're going to be able to do X, Y, or Z and help the domestic economy by increasing tariffs, the Smoot-Hawley Tariff Act, and therefore, it's going to drive domestic production because we're going to cut off imports. And all that did was just crater the economy and make it brought in the Roosevelt administration, a New Deal, and it really just was nasty. And
Yeah.
this is I hear the exact same rationale for these set of tariffs, and right now I wouldn't be surprised if we don't get the exact same result.
Yeah. Without being the history buff Ed is, I would say the consumer, us, will feel the pain on this for a while. Yeah. We'll be frustrated by prices and things like that for some time.
The only good thing is from my seat, the president doesn't really have he's not a dyed in the wool. He's a pragmatist. So if things start going south fast, he'll blame somebody else for it and
That's
change the
right.
policy.
Yeah.
So I'm kind of counting on that.
Yeah.
In terms of recession likelihood, what percentage would you say we're going to be going into, like 100% we're going into a recession, or I give it 25%, and the next 12 to 18 months we'll be in a recession?
100%.
It is 100%.
Yeah.
Matter of fact, we had 1 quarter of negative economic growth last quarter. And if you get 2 quarters of negative economic growth, that's technically a recession to this economist. And so you're going to end up, I think we've got a 100% chance that in the next 18 months, we're going to have a declared recession.
2 consecutive quarters.
Quarters of negative
That's right.
economic growth. Yep.
Yeah.
Rory?
So, no, I'm not in any disagreement with Ed on that one. Yeah.
100%.
Yeah.
Wow. Is there
I think
anything
there's gradations of the depth of recessions and such like that.
That's
So
okay.
that I think remains to be seen. And what we have seen in the past is, I guess, there will be intervention if and when that happens in one way, shape, or form, monetary, most likely. So yeah, I think it's I would say almost inevitable. Yeah.
Do you think that, last question
Yeah.
here, do you think that America and or other world leaders will be able to get us out of the recession quickly?
Probably. Yeah. Relatively quickly. Yeah. Yeah.
Ed's face is, I don't like Ed's face.
I'm, the lawyer in me is going, so how do you define quickly?
Right. I don't think
Fair.
I don't think it'll sink into a depression by any stretch.
Yeah, I was about to say, what I don't expect is that we're going to be in a depression where there is no recovery for years, like there was after the Great Depression, which really took us. World War II was the catalyst that got us out of the Great Depression. It was a 10-year recession essentially. I don't expect something like that to occur because, again, I think the good news in this particular situation is the American voter votes the economy. And so if the economy sucks, the American voter is going to change administrations in the in the next cycle. And then the other piece of good news is we've got a lot of levers to pull on economic growth. And so as a result, I think it's nothing major, but I think you could see a recession for 3 to 4 quarters.
Yeah, I agree with that.
But I don't think it's going to be. I don't think it's going to be a 2008 type recession.
Crater.
No.
Okay. Any other good news tidbits to leave us on? What's something good happening in the economy?
In the economy?
Or in the world? I'll broaden it. Just anything good. Well, I don't want to leave it on like the downbeat of we're 100% going to be in recession.
Yeah. Well, why do I have to think so hard about? I mean, like, why is it so hard for me to come up with something?
Long pause.
Yeah,
here.
no kidding. I mean, that's the honest to God truth of it is there isn't a lot I can point to and go, this is just great news. This is a great opportunity that's coming down the pike. Right now, the biggest thing from my seat is, like I kind of said at the beginning, we're in a position right now, like professionally, where folks who are, in consulting, in financial services, that where we can help people who are concerned with uncertainty, kind of get them calmed down and get them strategized for a way through that uncertainty. For folks like me professionally, that's great. No argument there. That's actually I'm looking kind of positive. Anything that's a little bit shaky provides the consultant in me a good meal ticket, but it's not great. There's not much great for the entire universe.
Sure. Yeah. Well said.
All right. So it's good for Ed. So take that to heart.
Rory,
we got our health, we got our family, we got our, overall,
so
we're living.
Feel good about that. We do have some levers to pull. It sounded like if we go into recession, we have some levers to pull, and it might be time to be a contrarian and look for those opportunities. There's always a upside or silver lining if you look for it and get creative. All right. Private equity experience. We're back, baby.
We are back. It's good to be back. Great to be
back and better than ever.
Thanks, Ed. Thanks, Rory.
All right.
Thanks, guys.
Bye.
If you enjoyed today's episode, please like, share, and subscribe wherever you get your podcasts.